Professional traders and investors have one common obsession: interest rates. They know that rates control stock markets, crypto momentum, inflation, and even the price of your house. Today, you will learn everything you need to know about interest rates and how to use them to make money. But alright, so let's begin here by answering the very important question: what are interest rates? And in very simple terms, the way I like to explain interest rates is that they represent the cost of money. So how expensive or cheap is money right now? So they basically show how, as I said, how expensive or cheap it is to borrow money. So if the interest rates are low, that means that you can get access to money cheaply, while if the interest rates are high, it's expensive and hard to get access to money. I really think this is the easiest way to think about interest rates. And interest rates are often expressed as a percentage and pretty much always per year. So if we say that the interest rates are 3%, we mean 3% per year. You almost always talk about yearly rates, but you can also talk about, maybe quarterly or monthly, but then they often specify that specifically. But here, as I already briefly mentioned, higher rates means that borrowing costs more, it's harder to get access to money, while lower rates mean that money is cheaper and it's easier to get access to money. But right, so now you might of course wonder, since interest rates are such an important thing, how easy is it to get access to money or not? Who actually sets the interest rates? Well, the interest rates are mainly set by the central banks. So banks like the Federal Reserve is the central bank in the US, set something called the base interest rates. And from the base interest rates is where pretty much all other interest rates comes from. So the base interest rate will influence all other rates in the economy. So it influences things like loans. So how much do you have to pay on your mortgage? It influences credit cards, savings, car loans, you name it. It influences all kinds of loans. And here, central banks will raise or lower interest rates to either cool down or stimulate the economy. Because remember, the interest rates control how easy it is for people to get access to more money, to more capital. So if the economy is, growing too fast, which can lead to inflation, we can actually raise the interest rates to cool it down. But we can also do the opposite. We can lower the interest rates if we want to stimulate the economy. And by the way, guys, learning more about central banks and how things like money printing works is super, super important. And luckily, I actually do have a video about money printing and how the Federal Reserve and other central banks prints money. So I highly recommend to check that video out if you got time after this one. But right, so now I want to quickly show you guys where you can find all interest rates and so much more. And the platform I use for all my economic analysis, if you have been following the channel, you also know that I use this platform for all my trading as well. The platform is called TradingView. And I do have a special link to TradingView. I will make sure to leave it in the description below, as well as in the pinned comment. But to get access to all the interest rates in the world, you want to go to TradingView, then you go here to markets, and you go down to economy, and then we go to interest rate right here. And as you can see in the beginning, you can see 4 countries with different interest rates. I think these countries are good examples because they do have some pretty extreme interest rate. If you, for example, look at this sort of red or, the red line right here, or I don't really know how to explain the color, but you can see that this is Argentina, and they had an interest rate of around 120%. This was in 2023, and that is an extremely high interest rate. And that is because Argentina has been having tons of problems with very, very high inflation. So they try to use the interest rate to sort of battle the inflation. But if you want to look at more normal numbers, you can go either here to Europe. For example, I live in Sweden, so you can see we scroll down here, we can see that Sweden's interest rate is around 2%. That is in the more normal range. You can see that most countries here have 3.65. I think the reason all of these have 3.65 is because of the EU. But if we also go here to North America, you can see that the United States is right now at 4.50. If we want to open up the chart, we can simply press right here and we can get a detailed chart of the interest rate. Currently, the Federal Reserve is talking about lowering rates. The market expects that the Federal Reserve will cut rates pretty soon, but for now it has been maintained here at 4.5 for a while. One more interesting thing I can just point out here is that we did have a period when the interest rate was all the way down here at 0. And this was because of the COVID pandemic back here in 2020. That was extreme times. The Federal Reserve lowered the interest rates down to 0 in order to try to prevent the market crash from happening. They wanted to stimulate the economy, get more money out in the economy. But that, as you might know, led to a very high inflation later. So you need to be careful when you drop interest rates, especially to these low levels. But right, so now let's dive a little bit deeper into interest rates and inflation. And as we have been talking about, raising interest rates makes borrowing more expensive. Or in other words, access to money gets harder. Less money will be put out in the economy. And this reduces spending and helps to slow down inflation. The opposite is true if we are lowering interest rates. This means borrowing cheaper, it's easier to get access to money, which means that we spend more, which means that we push inflation higher. So an example right here is in 2022, where rates were raised quickly to bring inflation down. And this was to fight the inflation that pretty much started with the zero rates environment we had during COVID. Next, I want to talk a little bit about interest rates and bonds. This is a very interesting relationship because interest rates and bond prices move in opposite direction. And when rates rise, bond prices fall. And this is a little hard to explain in this brief time we have right now. But it's basically when the rates are getting higher, you will get paid more on new bonds, which means that the prices of our current bonds needs to drop in order to adjust the rate up. And I totally understand, this explanation is not sufficient. If you don't know about bonds, this will probably not make sense. But you are in luck because I do have a full video on bonds where I explain bonds and interest rates and how they work together in very simple terms. So I do highly recommend that you check that video out after this video. I will make sure to link that video in the video card as well as the description below. And the opposite is of course also true. When rates fall, bond prices rise. And this happens because new bonds, this is what I tried to explain, the new bonds pay more or less interest, which change the demand for older ones. But as I said, if you don't understand this right now, it's totally normal and it will take some time to learn it. I highly recommend to check out the video I linked. But right, so now let's switch the attention and take a look at how interest rates and the stock market works together. How does interest rate affect the stock market? And in very simple terms, it works like everything else. Higher interest rates often leads to falling stock prices. Why? Because borrowing costs more, which both leads to people like me and you having less access to money, which means that we can buy less stocks, but it also means that the companies themselves have less access to money, which can often make it harder for them to make money. So in these kinds of environments, people tend to seek safer investments. So they might buy stocks that have a track record of very safe, maybe dividends and stuff like that, to sort of try to protect their stock market portfolios. But here, lower interest rates is the opposite. It often helps stocks rise because cheaper money boosts both business activity, but they also boost our activity, you know, the traders' activity, because when we see rates are cheap, maybe, you know, maybe if rates are zero, I can just borrow money and buy, you know, stocks. That is not really exactly how it works, but in general, that's pretty much how it works. You know, people have easier access to money and can buy more stocks. So in these environments, investors tend to look for more risky assets. So instead of buying safe dividend stocks, they might buy more growth stocks and so on and so on. So as I said, growth stocks like tech are more sensitive here to these kind of rate changes. But right, so now let's switch attention here and take a look at how does rates affect Bitcoin and cryptocurrency. Well, just like you know, tech stocks, crypto does much better in low interest environments, at least so far, because these kind of cheap money, when you get cheap access to money, people are more willing, as we have been talking about, more willing to take risks, and this leads to more, you know, crypto going well. However, I would say that this might be even more true for altcoins, which people see as much more risky compared to Bitcoin. Bitcoin is a little bit more special because it is getting more and more widely accepted in the cryptocurrency, and while it does many times trade in the same direction as risk on assets, lately we do see some days when Bitcoin instead, you know, moves, for example, like gold. So Bitcoin is in this sort of weird spot, a very interesting spot where it almost like tries to figure out what to be, if that makes sense. Super interesting. I'm really interested in the crypto industry, and it's super interesting to follow how interest rates affect these kind of markets. So here, in general, high interest rates reduce demand for speculative assets like crypto. But as I mentioned, I like to separate Bitcoin from crypto. It's actually, you know, not the same thing. But all right, so last but not least here, I want to take a look at how interest rates affects, you know, me and you, our personal finance. So we have already been talking a little bit about this, but it does affect loans and mortgages. I don't know why I have such a hard time saying the word mortgages. For some reason, I have a hard time saying it. But it affects loans and mortgages because higher rates means higher monthly payments. It's as simple as that. It also affects things like credit cards because our rates on our credit cards also increases when central banks raises the base rate. Even things like, you know, our savings get affected because banks offer higher returns when interest rates rise. So this is actually a good thing. If you have money in a bank account which gives interest, you can actually benefit from higher rates because this is like you are loaning out your money to the bank and you will get payments from the bank. So this is a scenario where you can benefit from interest rates. And last but not least here, your ability to borrow or save is of course directly affected by the cost of money. But right, so a quick summary before we wrap up. Why does interest rates affect everything? Well, it shapes how money flows through the economy. It shapes how cheap or expensive money is. And they impact things like inflation. We have been talking about that, bonds, stocks, crypto, housing, and daily life. And you now know exactly how and why. Central banks adjust the rates to manage growth and price stability. So they try to manage inflation, that is their main job, but they also manage related things like the job market and, you know, the GDP growth and stuff like that. And here, if you can understand interest rates, it will not only help your trading, your investing, but it will also just help your life in general. But alright guys, so that's pretty much it. If you guys want to support the channel and at the same time get access to presentations like this one, I try to release pretty much all my presentations to our YouTube channel members. So as I said, if you want to become a channel member, you can do that by clicking join down below. It's a great way to get access to exclusive videos, as I said, presentations like this one, and at the same time supporting the channel. So I would love to see you guys in the YouTube community. And now, if you are ready to dive deeper into the world of economics and finance, I highly recommend to check out this playlist next. But for now, take care. Ciao, ciao.